Index funds. You may wonder what this term refers to. Before we dive deeper into this video, ask yourself the following questions. Why would I want to invest in index funds? Is it the trend nowadays? Is it beneficial for my retirement or anything that involves my future? Well, investing in index funds needs the right motivation and intention. If you're doing it for others and not yourself, better reconsider your decisions. Allow me to tell you that with that kind of mindset and motivation, index funds will not work for you. Successful investing begins with thorough evaluation of financial decisions, then the planning will follow. Why do people invest? The most common goal of investing revolves around financial security, retirement income, home ownership, and diversification. These goals should be the reasons why you want to invest, especially in index funds. They should be deeply rooted in your heart and mind. However, all of these are useless and nothing if we do not understand its relevance and importance. As we open the video today, we would be answering the following questions that are vital in learning about index funds. What is a stock market index? How do stock market indexes work? What is a stock market index fund? What are the benefits of index funds? What are the drawbacks of index funds? How to invest in stock index funds? Are index funds a good investment? Welcome to another video, financial buddies. We will be learning about investing in index funds and how you could earn over $400,000. Want more videos like this? Make sure to subscribe and click the notification bell to keep you updated whenever we post new videos. This is Financial Intellect, and we promote that to be finance savvy. We are your buddy. Let's get started, shall we? What is a stock market index? To know how index funds investments work, we need to establish an understanding on how stock market indexes operate. A stock market index is a collection of data that follows the performance of a group of stocks. Investors use indexes to assess the stock market's overall performance and day-to-day changes. For example, the S&P 500 is a stock market index that includes 500 of America's largest publicly traded corporations. Many well-known companies are represented in the index, including Amazon, Microsoft, Starbucks, and others. The stock is priced individually, and the prices will change based on how well the company performs. Usually, investors would look at the stock price movements of individual companies. However, indexes now offer a more straightforward way to assess the broader market. Stock market index and index funds are related because an index fund is a type of investment that attempts to replicate the performance of a specific stock market index. Thus, the importance of knowing this basic concept. How do stock market indexes work? Stock market indexes are a collection of companies picked by the index manager for inclusion. They are chosen based on factors such as the size of the company, the geographic region, industry of the company, its profitability, liquidity, and etc. Once the company is selected for inclusion, the company's share price will be included in the calculating price and performance of the index. An index considers the total price change for all the stocks in the index. This gives you a bird's eye view of the total market on any given day. What is a stock market index fund? A stock market index fund, an investment product, allows investors to buy all of the companies within the underlying index. An index fund aims to replicate the performance of a specific index, and it can be purchased through a brokerage account. How do index funds work? Generally, index funds are made up of company stocks that are chosen based on a variety of factors such as asset type, business industry, and market opportunity. An example is an index fund that is tracking performances of bonds in cash commodities, or an index fund that is tracking stocks in a specific industry. Once you understand the basics, then you will be able to understand how to pick the right index that would align with your goals. One tip on investing is not to keep all of your eggs in one basket. It means not to limit yourselves in one index fund. Buying shares typically has two methods. The first one is approaching the mutual fund that owns the index, and the second one is opening a brokerage account to start trading in index fund shares. With these methods, you are not limited to either stock index funds or bond index funds. Index funds are passively managed, which means that managers do not actively buy or sell stocks to make short-term profits. They buy the stocks that are included in the index, and they will be buying more as the fund grows. Then, they sell companies that are removed from the index, but they will not actively trade or try to time the market. This is beneficial because it results in lower fees and it results in lower turnover of assets. In addition, there are two vehicles wherein these funds come in. First, the exchange-traded funds, or ETFs. They trade like stocks, have a ticker symbol, and can be bought or sold instantly during market trading hours and have prices that change constantly throughout the day. Second, the mutual funds. They trade only at the end of the trading day, have prices that change only once per day, and may have higher fees than ETFs. Benefits of index funds. Index funds are a popular investment option. In fact, passive index funds have more money now than actively managed funds. So, why do people pour their investments into index funds? Here's why. Low costs. In general, index funds are a low-cost investment. To run the fund, most funds charge a tiny fee called the expense ratio. However, this cost is usually negligible, typically 0.1% or less. To put it in perspective, on a $10,000 investment, that's only a $10 fee every year. Many actively managed mutual funds, on the other hand, charge 1% or more. On the same $10,000 investment, that's a $100 fee every year. Continuous fees can have a significant negative influence on your investment results over time, so it's critical to keep them to a minimum. Simple diversification. What level of diversification do you desire in your portfolio? Diversification is one of the most crucial factors that will dictate the success and failure in the stock market. Diversifying your portfolio is like putting your eggs in different baskets. If one fails, you still have some money to count. In other words, it helps reduce the risk of being disadvantaged in your investment. Passive investment. Investors who want a hands-off approach can simply invest in an index fund, which will closely track the general market's results. Index funds are a passive, non-active investment strategy. To put it another way, you don't need to be an expert investor to begin investing in index funds. It is a reasonably simple method for getting started with investing. While there are benefits in investing in index funds, it also comes with drawbacks and disadvantages. Limited control. Investing in index funds means putting your faith in the stock market as a whole. You're basically going along for the ride, whatever that ride may be. This isn't always a negative thing. Individual investments, on the other hand, may be preferable to index fund investing for investors who like to steer their own financial selections. Limited to one type of stock. Many index funds are limited to a certain type of stock. Some total stock market index funds track thousands of small, medium, and large cap companies. However, the vast majority of index funds concentrate on a particular market category. You will never beat the market. Index funds are a type of mutual fund that attempts to replicate the performance of the stock market, or a section of it. This strategy can yield reasonable, steady returns, but index funds will never beat the market. Are you learning a lot? If so, we would like to hear about your thoughts and learnings from the video. Do share your answers in the comment section. How does one invest in stock index funds? Follow these 3 easy steps and you will be on your way to index fund investments. Number 1. Choose an index. Select an index that you want to follow. You can gather some ideas in the popular indexes by browsing the fund company website. Number 2. Choose an index fund. Once you have finished choosing an index, it is time to select the index fund. The factors that you should look for are low fees, the fund's performance, after fees, and the fund structure. You can buy index funds from Vanguard Total Stock Market Index Fund, or VTI, Vanguard Total International Stock Market Index Fund, or VXUS, Vanguard 500 Index Fund, or VOO, Vanguard Total Bond Market, or VND, Fidelity Zero Total Market Index Fund, or VZROX, or Fidelity Zero International Index Fund, or FZILX. Other low-cost ETF managers include Schwab, BlackRock, and iShares. Number 3. Buy index fund shares through your broker. It's time to invest. First, transfer your money into your brokerage account. Second, type the fund you selected into your stockbroker's platform. Third, select Buy and enter the amount you wish to purchase. Fourth, for mutual funds, enter in a dollar amount. Fifth, For ETFs, you may need to enter in a number of shares instead. 6th, use the market price option. 7th, place the order. If you buy an ETF while the market is open, your order will be filled immediately. When it is closed, it will be processed when the market opens the following business day. Are index funds a good investment? Index funds are a great way to invest passively. They are a great option if you do not wish to actively research stocks, conduct due diligence, or monitor your assets. It is excellent for long-term wealth accumulation, especially with keeping a tight eye on market performance, which tends to increase significantly over time. Yes, individual stocks are worth investing in if you want to generate very high returns and if you are also willing to put in the additional risk. But if you only want to put in moderate risk with moderate return of investments, index funds are for you. This is what most of you have been waiting for. How will you earn $400,000 or more? Investors who are investing for quite some time now use this method they call the classic way of earning it slowly. Investing in a good, balanced portfolio that is diversified between blue-chip companies and investment-grade bonds is a tried and tested strategy to double your money in a reasonable amount of time. Start investing now and double your earnings slowly. How did you find the idea of index funds in today's video? Have you learned anything? It was a pretty complicated concept to grasp, but we are all here to learn. That's it for today, and we hope to see you in our next videos, financial buddies. Do not forget to like and subscribe if you haven't yet. Click the notification bell for you to be notified whenever we post new videos, and make sure to share this with your friends. Sharing is caring. We are Financial Intellect, where we promote that to be finance savvy, we are your buddy. See you!